Have you ever wished you could profit from the stock market even when prices fall? Or protect your portfolio without having to sell your favorite stocks? That's where futures and options come into play. These financial tools, also known as derivatives, may seem complex, but once understood, they open up powerful strategies used by smart investors. Whether you're just starting or seeking to sharpen your trading skills, this guide will walk you through the essentials of futures and options in simple, relatable language. Section 1. What are futures and options? Introduction to derivatives. Derivatives are contracts whose value is derived from an underlying asset such as a stock, index, commodity, or currency. Futures and options are the most commonly traded derivatives. A futures contract obligates the buyer and seller to transact the underlying asset at a predetermined price on a specified future date. It is binding for both parties. An options contract, on the other hand, gives the buyer the right, but not the obligation, to buy or sell the asset at a set price before or on a specific expiration date. There are two types: call option, right to buy; put option, right to sell. Section 2. Why learn about futures and options? Understanding futures and options allows investors to protect investments, use them to hedge against potential losses, generate passive income, sell options contracts and earn premiums, profit in all markets, whether prices go up, down, or sideways, use leverage, control large amounts of value with a smaller investment, but this magnifies both gains and losses. Even if you never trade them, understanding how they work will help you follow market trends and news more effectively. Section 3. Understanding futures contracts. What is a futures contract? A futures contract is a legal agreement to buy or sell a particular asset at a fixed price on a set date in the future. This agreement is standardized and traded on exchanges. Key features. Standardized contracts. All futures have defined terms, like expiry dates and contract size. Margin requirements. You don't pay the full amount upfront, just a percentage known as the initial margin. Mark-to-market. Gains or losses are settled daily. Obligation to buy, sell. At expiration, both parties must settle the contract unless closed early. Example: suppose you buy a futures contract for 100 shares of XYZ at $50. If price rises to $60, profit equals $10 times 100 equals $1,000. If it falls to $40, loss equals $10 times 100 equals $1,000. You can close the contract early by selling the position before expiry. Section 4. Understanding options contracts. What is an options contract? Options provide flexibility. Unlike futures, they don't obligate you to execute the trade. You simply pay a premium for the right to buy or sell. Key terms: strike price, agreed price for buying or selling; premium, fee paid to buy the option; expiration date, final day the option can be used; lot size, number of shares per contract. Example: you buy a call option on XYZ. Strike price, $100. Premium, $5. Current price goes to $120. You buy at $100, sell at $120 equals $20 gain. Net profit equals $20 minus $5 equals $15 per share. If the stock stays below $100, your loss is limited to the $5 premium. Section 5. Key differences between futures and options. While both futures and options are derivatives used for hedging and speculation, they differ significantly in structure, obligation, cost, and risk. Futures contracts require both the buyer and seller to fulfill the agreement to buy or sell the underlying asset at a specified price and date. This creates a binding obligation. In contrast, options contracts give the buyer the right, but not the obligation, to execute the trade. This flexibility makes options more appealing to cautious investors. In terms of cost, futures typically require a margin deposit, which is a fraction of the contract value and is adjusted daily based on market movements, mark to market. Options, however, require the buyer to pay a premium upfront, which is the maximum amount they can lose if the trade goes against them. The risk profile of futures is higher, as losses can be unlimited if the market moves sharply against your position. Options offer limited risk for buyers, as the loss is confined to the premium paid. However, sellers, also known as option writers, can face substantial risks if the market moves unfavorably. When it comes to leverage, futures provide high exposure to market movements for a relatively small margin amount. Options also offer leverage, but generally to a lesser extent than futures, depending on the premium and strike price. In terms of usage, both instruments are valuable for hedging and speculation, but options offer an additional advantage, income generation through option writing strategies, such as covered calls or cash-secured puts. Section 6. Use cases of futures and options. Hedging. Investors and businesses use derivatives to protect against unfavorable movements in prices. For example, a farmer hedging against falling crop prices. A stockholder using put options to guard against a market dip. Speculation. Speculators aim to profit from price movements without owning the underlying asset. Buy a call if you expect prices to go up. Buy a put if you expect prices to fall. Use futures to take direct long or short positions. Income generation. Investors write, sell options to collect premiums. Covered call, sell a call option on stocks you own to earn extra income. Cash secured put, agree to buy a stock at a discount in exchange for premium income. Section 7. Risks involved in futures and options. Futures risks. Unlimited losses, price can move drastically. Margin calls, broker may ask for more funds if losses mount. Emotional stress, volatile markets require constant monitoring. Options risks. Time decay, option value decreases over time. Complexity, prices depend on multiple variables, volatility, time, etc. Liquidity risk, low volume options may be hard to exit quickly. Section 8. How to start trading futures and options. Open a trading account. Choose a broker with access to derivatives markets. Complete KYC and enable F&O segment. Learn the basics. Understand the core terms. Strike price. Expiry. Premium. Intrinsic vs time value. Lot sizes. Use simulators. Practice with demo accounts to build confidence without financial risk. Start small. Begin with low-risk trades. Learn how volatility and leverage affect your capital. Section 9. Tools and strategies in F&O trading. Covered call. Sell a call option on stocks you own to earn income while keeping the stock. Protective put. Buy a put to protect against a fall in stock price, just like insurance. Straddle and strangle. Straddle, buy both a call and put at the same strike. Strangle, buy out-of-the-money call and put options. Spreads. Combine long and short options with different strikes for expiries. Reduce risk and cost compared to standalone options. Section 10. Taxation on futures and options. Classified as business income in many countries. Short-term gains taxed as regular income. Keep detailed records of transactions. Seek guidance from a tax professional, especially if F/O forms a major part of your activity. Section 11. Common mistakes to avoid. Trading without learning the basics. ignoring stop losses, over-leveraging and blowing up your account, chasing losses out of emotion, assuming profits are guaranteed. Section 12, final thoughts. Should you trade F/O? F/O are powerful tools, but they come with real risks. If you're a long-term investor, options can enhance your returns. If you're a short-term trader, futures offer opportunities, but require skill and discipline. Focus on education, strategy, and risk management. Don't trade what you don't understand. Conclusion: futures and options simplified. Here's what to remember. Futures equals obligation to buy or sell. Options equals right, not obligation. Both can be used for hedging risk, generating income, speculating on price movements. With the right knowledge and discipline, these tools can become part of a smart, flexible investing strategy. If you found this guide helpful, like, comment, share, and subscribe for more beginner-friendly financial education.